Hi, I'm Sean Millington. In this, our fifth segment, we will look at preferred shares. Although technically preferred shares are called equity, in reality they are more closely aligned with debt instruments than they are with ownership. Like common shares, they are usually traded on an exchange. With characteristics of both debt and equity, preferred shares may reduce an investor's risk versus owning common shares, but they may also limit an investor's reward, as preferred shares do not appreciate in price the same way that common shares do. When you buy a preferred share, what you're essentially buying is a cash flow in the form of a promise of a fixed dividend payment on a regular basis, typically a dividend paid quarterly. This makes a preferred share similar to a bond, but with much different tax treatment, which we will discuss later. The amount of the dividend is fixed at the time the preferred share is issued and paid before dividends on common shares, but the dividend isn't increased if the company increases its profits. If a company's ability to pay interest and dividends deteriorates because of lower earnings, the preferred shareholder is better protected than the common shareholders, but behind the claims of the bondholders. There are many different types of preferred shares, so we'll only look at some of the more common features. Preferred shares are usually given a prior claim to assets ahead of the common shares in the event of a winding up or dissolution of a company. Preferred shares are usually entitled to a fixed dividend, and that dividend is paid before any dividends can be paid to common share owners. Unfortunately, if the board of directors cancels the payment of a preferred dividend, there is very little a preferred shareholder can do about it. The value of preferred shares fluctuates much the same as bonds. That is to say that if interest rates decline, the preferred shares will increase in value, and of course the reverse is also true. Typically, preferred shares are issued at $25 and will be redeemed at $25. While most preferred shares are redeemable, that is to say that the company has the privilege of redeeming the preferred shares on a certain date at $25, there is no assurance that the redemption will occur because the benefit privilege is in the hands of the company. However, with a retractable preferred, it is the holder that can force the company to buy back the shares and effectively create a maturity date by exercising this option. Thus, a retractable preferred is effectively a share with a fixed maturity date, and the company must repay $25. In recent years, the most common type of preferred share has been the fixed reset preferred. Typically, the company issues the shares with a dividend yield that will remain in place for 5 years. At that anniversary, the issuer will have the option to redeem the share at $25. If they elect not to redeem, they will be obliged to reset the dividend for another 5 years at a percentage rate with a formula linked to 5-year Government of Canada bonds. For example, the dividend is set at 4% for 5 years, but will have to be reset at 2.5% above the Government of Canada 5-year bond rates. In 5 years, if the 5-year Government of Canada rates are 4%, then the dividend will then be set at 6.5%, assuming the company elects not to redeem. As a result, all things being normal, we would generally expect the share price to return to $25 every 5 years. Until the 1970s, nearly all preferred shares were perpetual. That means that the dividend was fixed forever, with no opportunity or expectation of the company redeeming or having to refinance the share. As interest rose through the 1970s, investors came to shun these shares and demand the retraction benefit. In recent years, perpetual preferreds have become very common. Although the rates from these shares can be quite attractive, investors need to recognize that there is a time to sell them when interest rates start to rise. There are many other preferreds, and they can have almost every imaginable variation you can think of. For example, this table shows the many types of preferred shares issued by Bell Canada Enterprises that currently trade on the Toronto Stock Exchange. Each preferred series represented by the letter has its own unique terms. As a result, research is required to understand their unique idiosyncrasies. Now, why do companies issue preferred shares? In comparison to bonds, preferred shares are usually more expensive for a company to issue because dividends paid are not a tax deductible expense for the company, whereas interest payments are tax deductible. However, investors find preferred shares very attractive as the tax burden on a dividend check is half the tax on an interest payment received. Indeed, the way the tax system works, dividends are an extremely attractive way to earn a fixed income. Because of the wide variety of preferreds available, there's often a place for certain preferreds in everyone's portfolio. That wraps up our discussion on preferred shares. Please come back and watch upcoming segments. I'm Sean Millington.